Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard.
I should say Tony Soprano.
Exactly. He wished he looked this good.
All right, you folks, you got to go on our website. I'm gonna put a fake picture up there with a gold medallion and a jogging suit. Tell me if that doesn't look like Tony Soprano.
I'm gonna do that for Halloween, and now you just blew it. I'm wearing a nylon gym suit and a medallion.
Yep, you got to have like a St. Christopher medallion or something.
Get a Cadillac Escalade. We've had it in the past.
That's right. I had back in the 90s one of those chopped off Cadillacs, the chopped back end.
Seville.
Yep. That was an ugly car.
I was never quite sure if I loved those or hated them. They were right on the cusp. Could go either way.
And the front seat's totally different. Back then, remember, you had to reach like a mile just to turn the radio on.
Yeah, that's right.
And the front seat was like a couch.
No remote buttons on the steering wheel.
It was like a couch.
It was.
I was like, I think I'll take my eyes off the wheel just to change the radio on.
Which is why you went with velour instead of the leather, because if you took a hard left, you'd be all the way in the passenger seat.
A friend of mine had a Jaguar back then. That was the first that I had seen.
XKE?
I don't know what it was.
Or a four-door?
It was a four-door, but it was the first of the cockpit-style cars. You know, where everything's close. Now, I don't care if you get the biggest Escalade or whatever, everything's real close to you.
Now, I got to ask, is that the mutual friend that we have, that Jaguar was such a POS, piece of junk, that he took the motor out and dropped it off at the Jaguar dealership on their doorstep?
I believe you're right.
That was funny. This guy actually took the motor out of the car. They wouldn't give him the warranty. The warranty was out, or it had so much problems forever. When he had to replace the motor with his own money, he took the motor out, drove it over to the Jaguar dealership, and proceeded to dump it on their doorstep.
It is funny.
He would also get so mad he'd throw phones across the room in his office. You'd be sitting in your office on the phone or with a client, and all of a sudden you'd hear this huge commotion, and he'd peek out the door, and you know he was throwing stuff.
I have no idea what you're talking about.
I have no idea what you're talking about.
There's an interesting deal. They did a study, and they gave 11 occupations, and they said, what is the most trustworthy to the least trustworthy? So I was trying to figure out where we stood in that pile. I was afraid to look. But and now let me tell you, you've got people like car salesmen, stockbrokers, insurance salesmen, bankers, Congress, lawyers, business executives, financial advisors, financial planners, doctors, medical doctors, engineers, things like that. And so I just thought it was interesting how they came out. Well, the most trustworthy out of that group, engineers. Okay, that sounds about normal. Medical doctors were number 2. I don't know, I've been watching a lot of these medical shows where they keep making mistakes.
Overcharging.
I was like, oh my God.
Sticking it to the insurance companies.
They're protecting the hospital against lawsuits, so there's all kinds of things.
Hospitals have the largest margins now on the planet, but I digress.
No, that's why I was talking. They said, I hate insurance companies. I go, I get there a lot to blame. But also, when I got $17,000 bill for the hospital stay for 3 hours.
For your son's broken arm, yeah.
I was like, wait a minute. It's a day surgery. I was there for 3 hours. $17,000 for just the hospital part?
How much was your son's broken arm? Wrist?
I don't remember.
And then they didn't do it correctly.
Yeah, $3 or $4 deductibles.
And you questioned them when they were still as a lump sticking out his arm, and it was said, "Oh no, it was fine, right?" And then you had to go take it somewhere else.
Monday, and they said he should have said it Friday. I'm like, oh, here we go.
Yeah, right.
So I had to. Have you ever done those emergency room co-pays? Oh, they're good. I had to do 2 of those in a couple days.
Oh, yeah, and then you get hit with the deductibles and all that for several thousand.
Oh, yeah. And then
with good insurance.
You're putting everybody together, and you said, I want it all in network. Find out 2 or 3 of them aren't in network. Well, the radiologist wasn't. Well, why? I told you I need everybody in network. Well, sorry, it's all we had. Mm-hmm. Well, you can't trust any of them. Okay, engineers were number 1, the most trustworthy occupation out of this 11. Number 2, medical doctors. I guess that sounds right. Number 3, financial planners, and number 4, financial advisors. So that's not bad.
Opposed to stockbrokers and insurance agents.
And it's funny, though. Remember,
things like
back
that.
in the day, everybody was a stockbroker. Nobody was a financial advisor. That is actually a more recent phenomenon, right?
No, and then wealth managers. Every dog has its day.
Oh, yeah. Next would be business executives. I figured they'd be on the low end, but they're towards the high end of trustworthy. Bankers. Now we're starting to get into the ones that are...
Gray area. We're getting in the gray area.
Insurance salesman. No, nobody likes insurance. Remember that? What was that, Groundhog Day?
Yeah.
The guy kept trying to sell him a policy.
Yeah.
The stockbrokers. Remember, in the old days, you had to have a New York stockbroker if you had any money. You can't have just a Dallas.
Just think of Boiler Room, the movie.
Lawyers are the next one.
No, car salesman, wasn't it?
They're switched here.
Oh.
So it's lawyers, then car salesman.
Well, there's the line.
Well, I had a friend that was a car salesman. He made a lot of money, and he says, I like the work, I like the thing, but man, I can't get any respect from people. It don't matter how much money you make. They just think cars up, but I go, I didn't think about it. But what's the number one? What lawyers will be next? Nobody trusts lawyers, right?
Then car salesman.
Then it's lawyers, car salesman, and the most untrusted occupation in the world, Congress.
Why don't you say? Can we put it all on couch it under politicians?
That's right. Politicians are the least trusted people. Car salesman next, and then you got your
lawyers.
I think that's about right. What do you think?
I like it. I like the engineer part. I like the financial planner part.
Oh yeah. The another thing that came interesting to me, that when they start asking people, they ask people of different age groups if they're going to be rich when they get older. And of course, the ones closer to being older already are going to be the lowest number. The younger ones are always enthusiastic.
Absolutely optimistic.
Right. I was just excited how much optimism was there. It's like some huge percentage, like 70% of millennials still live at home. Yet 64% of them say they're going to be rich. 64%.
You know what, though? Optimism is a good thing. There was a movie that I was watching that's called Tomorrowland. You may have seen it. Yeah, George Clooney, Hugh, the guy that played in House, the doctor.
Oh,
Hugh Laurie.
Yeah.
Anyway, it was a good movie. And the father was telling his son, George Clooney, when he was young, about these two wolves that weighed the same. They're in a fight. One was a negative, nasty wolf, and one was a positive, euphoric wolf. And the dad asked his kid, which one won the fight? And the kid shrugged his shoulders, says, I don't know. And his dad said, the one that you feed. Meaning, if you're positive and you head down that track, you got a much better chance. So those kids that think they're going to be wealthy have a much better chance than the ones that don't.
I think somebody needs to wake them up and say that, there's not 1% of the people are going to be rich. The highest you could get was the next generation, I think X's or Y's or whatever, and they were like 25%. Then you got into boomers like us, and it was like 12% because we're close already.
I don't know what the numbers are anymore, but remember when we're probably talking 80s now, but if you made $100,000, you were in like the top 2% of the country.
Yeah, it's I think 100,000 now is the top like 8-10%.
Is it? I wonder what the top 2% is.
It's like 250.
So the point being, to be in the top 2% isn't like you're making $5 million a year.
Right.
So
that's what I always complained about Bernie Sanders to my son, who's a big sporter. I said, wait a minute. This man's never made more than $170,000. He never had another job.
Right.
Community organizer like Obama, right? Community organizer,
never
then senator, right?
Yep.
Never made more than $170,000 a year. Yet he's worth millions of dollars. He's got $3 or $4 or $5 million in real estate alone in houses. How did you get there? How do these politicians go and make? Because I know a whole lot of people that make $170,000 a year.
Yeah.
Not one of them is rich.
That's right.
Because you got to pay a lot of it in taxes, right? And you got the kids in school and all. How come this guy's got completely rich? That's because they're all crooked. That's why they're the lowest one trustworthy Congress.
And we see a lot of it. Now, that person that makes $170,000 a year, if he's frugal, if he drives a reasonable car, not a big Mercedes or big Lexus, if he has a reasonable house, right, $250 house instead of a $750 house, which he can afford the payments on the $750 house, right? If he has reasonable stuff, we'll end up with $5 million, which is a lot of money at retirement. But when you take that $5 million, right, and you try to get the income, it's good, but it's not like, champagne every day and bonbons.
There is no way you get $4 or $5 million in paid for real estate and all the cash and everything else, 15 cars, making $170,000 a year. It's impossible unless
I agree.
that's why they funnel this stuff like, we're going to give you a real estate deal. It's worth $10 million. We're going to give you $100,000. Or we're going to give you a book deal. I'm going to give you $10 million cash. Just promise to write a book somewhere in the next 10 years.
Or if somebody that supports them, if you vote for this, I tell you what, I will recommend that you buy that piece of property over there. Don't, no question, just go ahead and buy that piece of property. They buy that piece of property, and all of a sudden this stuff goes up around it, right?
Look at the last presidents, how they got in there poor and came out, filthy rich.
Well,
George Bush already had money.
Yeah, he didn't need it.
Yeah.
I still think the best way to do it is to form a foundation and only donate 5% to the poor and keep 95% for yourself. Just saying.
Oh, they put it out in salaries.
Oh, yeah, well, expenses, salaries, it's an expense.
You're talking about the Clinton Foundation?
I know nothing.
I'm going to expand a little bit on what we talked about a week or two ago about, because just this week I was talking to an attorney with one of my clients. They were trying to put some of their stuff into a trust. This is a common thing that happens. Typically, you don't want income-producing things in trust. I know lawyers will tell you everything should be in a trust, but if you get any income, if you retain any income in that trust, anything, right? If you retain it in that trust, anything over $12,500 a year, it becomes a 37% tax bracket. So you're going to pay almost 40% taxes on anything over $12,000 a year. Now think about it. Put it in perspective. The new tax rates, I think, for a single person, you got to make $500,000 a year to get in the 37. I think it's $1 million a year if you're married filing jointly. So no, it's only $12,000 inside that trust. Now, there are ways around it but you have to pay it directly to the beneficiary and all this stuff. And there's certain kind of trust you can do it, but normally they're trying to make a direct pass-through. Retirement accounts, annuities are already direct pass-through.
That's right.
And it's free. You don't have to pay for a trust or anything else. You don't have the hassle of putting in a trust. They also pass to your heirs immediately.
Judgment-proof to
100% judgment-proof.
Greater extent in Texas.
That's right. So they're actually better outside of a trust. But you can, if you had to, put them in there, but that's not what you should be doing typically. I understand they say, well, what's good is the trust. If most of your assets are retirement accounts or annuities, skip the trust.
Yep.
All right. Now, there is a difference. Let's say you have a handicapped child that needs to be taken care of. That's a different story.
Or
that's
if
a
you
different kind of trust.
Property with liability and stuff.
Now, appreciating assets are good to be in a trust because it creates no income. Like your house creates zero income, right? So that one is okay to be in a trust. Sometimes stocks, if you don't want to sell them, that's okay to be in a trust too. Anything appreciates but doesn't spit off income.
And there's exceptions to all these rules, because let's talk about the house. If you die, your spouse gets a stepped-up basis in the house.
I don't have no rules, to be honest with you. I know it's stocks for sure.
But, so there's some
that's right. They keep the same one, I thought. I don't know, though. I have to look it up now.
There we go.
Because I remember, you can listen to me on everything but real estate. So Guy could be 100% right. I know pretty much about every kind of investment. Every time I do real estate, it's the opposite of what you should do. But remember, retirement accounts, any kind of IRA or anything else, and honestly, they're supposed to be individually owned anyway, not trust owned. You can make them the beneficiaries, but then again, sometimes you defeat what you're trying to accomplish. You cannot make them an owner because an individual person has to be an owner. And by the way, it doesn't matter what they're invested in. Annuities, mutual funds, or whatever, don't put them in a trust. Like I said, you can put them as a beneficiary of a trust, not the owner. But if you even have a non-qualified annuity, you could definitely make the trust an owner. You just don't want to because it has so many protections that they're built in for free that you don't need to put in a trust and all that hassle. It'll still go to your heirs. And what you could do, like with an annuity, you can also, I'll give you an example. I got 4 kids. 2 of them I can give a lump sum to. The other 2, no way. There's no way they're getting a lump sum. Impossible. They'll just buy something stupid and be broke again, right? So you got to give them like a payout.
I'm wondering which 2 you can give it to.
I'm not going to tell you which 2.
I have an idea, but I'm not sure.
When you put you can designate, all right, I want 20 years of payments, 10 years of payments, life payments, whatever for that particular beneficiary. You can do all that for free in the annuity already. You don't need a trust to convolute everything and possibly ruin the things you're trying to do. Because I asked the person when they told me the lawyer said they want to put all this in a trust, said, what's your main objective for putting it in a trust? Well, I wanted to direct pass through. I go, your accounts are IRAs and annuities, and they already are. I go, well, what about I want control to be, it's automatically done. So remember, anything that has a beneficiary
Unless
is
you want it
automatically
allocated
handled.
to the, yeah.
But certain things don't have, because once you go into will, probate, every will is probated. You know, it's if you've got a simple estate, it's not too bad. But if you have a more complex estate, there's a lot going on there, so you got to be careful. And usually people put stuff in trust to get it out of their estate for estate taxes. That's a different issue. But retirement accounts really aren't the type you take over there. All right, so just want to clarify that. There are ways you can do it. It's just not ideal. Go with the general rule says don't put retirement accounts or annuities into trust.
Unless shown otherwise.
All right. We're getting a lot of, I'm going to read the headline of these 4 articles that have come out in the last 2 weeks. All right. One of them is, why making money in the stock market just got a lot more difficult. Next one, should Trump expect a recession? Every Republican since Teddy Roosevelt has had one in their first term. That was surprising, wasn't it?
If you consider Trump a Republican.
Yeah. All right, next. After 10 fat years of stock investors, a lean decade is looming. Here's another one. Low returns create bleak outlook for clients in retirement red zone. And here's the last one. The worst possible time to retire. If you've ever looked at, we've talked about the sequence of returns risk, right? If you ever have all your money in the stock market, or let's say half stock market, half bonds, whatever that mix is, and the market does real well your first 5 or 10 years of retirement, you get it's like 90-something% success rate, even taking out a larger than normal withdrawal rate. If you do less and take losses in the first few years of retirement, it is almost a certainty you will fail. Almost certainty. And so you got to be real careful, very careful, because remember we've talked about on the show. Remember the Shiller PE ratio is like 32? Every single time in history it's got to 30. The preceding 15 years, the best return it ever had is 2.4% a year.
I gotta kind of jar in my memory a little bit. I had a conversation earlier this week with a client that put 9 years ago, put $1.2 million with me that we put in fixed annuities. It didn't want the risk at all, and they didn't have the income available now that they do now. So I was going through her accounts with her, $1.2 million about 9 years ago. Now, and it's not sequence of risk, right? Because it's a fixed deal.
Lose,
you can't lose. You get up years, but not down years, like they talk about. But you're not making market returns either. You're not getting 20% years. Right. The accounts today, $1.2 million to start with. 9 years later, the accounts are worth $1,700,000, and she's withdrawn about $500,000. She's taken $500,000 out of the account. Oh, yeah. So add the 5 to the $1.2 million. It's $1.7 million. I mean,
no, I've had the same thing. I just talked to someone this week that this was not even that many. It was 10 years this year. Put in 550, took out 300 and something, and it's worth put in 520, took out 300 and something, so about 200 of his own money. It's worth 550.
So still worth 8 something.
More, yeah.
Yeah, so she's
still worth more.
Way ahead. So you take the $1.7 million left, and you take the withdrawals of 5, so it's like 2.2. And she started with 1.2. I mean,
that's why if you take out of something fixed.
That's right.
The only problem is that's what it eliminates the sequence of returns risk. In other words, if I need $50,000 a year on $1 million, right? If I'm in the stock market and it goes down 50%, I still need my $50,000 to live on.
That's right.
So it's $450,000.
And you have half the money to produce it.
That's right. $450,000. So I know if I got to take $50,000 a year out of that for the next 10 years, 1 year I'm down to $450,000. It's a death spiral. You will go broke. It just a matter of how long it takes.
Or you will change your lifestyle, and most people are very resistant to changing their lifestyle.
So let's say you put in something fixed, either a CD, bond, fixed annuity. You take out that same 5%. Well, it can't lose principal, right?
Right.
Besides what you're taking out. So in theory, it would take 20 years to run out of money if it never made a penny, right?
That's right.
As long as you don't have any fees. You got to disregard fees. If you got fees, you're going to have to lower that number. But so if you're 65, it's going to last to 85. And that's why you never take money out of stock market stuff. Everybody that tells me, I do this and I only do dividend, blah, 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 because it doesn't touch your principal, dividends can go away tomorrow. I looked at one of the really good dividend stocks the other day. Wasn't AT&T. AT&T's been pretty steady. But this one was, my mind just went blank. But a really good one.
Yep.
But even in the last 20 years, that thing's been all over the board. And your bills aren't going to quit coming just because they lowered the dividend or the capital appreciate. You cannot ever do something that's not some kind of guaranteed against loss or some kind of fixed interest rate. That's the only one, because think about it. 20 years taking out 5% a year, if it never makes a penny, which is going to make something, right?
And I tell you, it gives you a lot of options. In that same phone conversation, she's taking X amount a year out with her Social Security and all of that, but she wants $80,000 now a year. I want to take 80. She goes, Guy, and she's 84 in her mid 80s. She goes, can I take out $80,000 a year and make it another 10 or 15 years? I said, if it made nothing at 1.7, you could take $80,000 a year out for 21 more years.
That's right.
Without it making anything. So, I mean, you stick to your plan, you make sure you don't run out of money, but you can increase that when you need to, especially when as the lifespan becomes shorter.
Yeah, it's amazing. Go ahead and change your thing, guy. I'm seeing guys' battery going boop, boop, boop. It's about to go dead. You're right. There's always a thing that when these people try to put simplistic plans together, they're really telling you what you want to hear. In other words, I want to stay with the allocation I've got, maybe tweak it a little bit. I don't want to buy any CDs or annuities or bonds or anything. Just keep me in my mutual funds I'm in. But they never, ever discuss the sequence of returns risk. And basically, they're risking your retirement that they won't ever have a down year or ever have maybe a couple down years in a row. If it's significant a month, one down year will delay your retirement 5 years. That's why all these people are saying after a 9-year bull run, it is absolutely the worst possible time to retire. Now, what do you do if you have to? I mean, this is your time.
Is 9 years the absolute record, or is it just one?
No, it's the absolute record.
It's the absolute record, right?
But like I said, you've got stocks. They've got. I could give you a copy of any of these articles that have just come out. But they're talking about there's a slowdown. Remember, it was going like gangbusters. Trump's first year, all the way in the beginning of this year. Now it's back and forth. Like 2 weeks ago, it was down for the year. Now it's up barely for the year. It's all over the place. But once it gets to that kind of volatility, like a bear market is preceded by volatility most of the time.
And we're in what they call now a trading range.
Right. And remember, we've already talked about this 100 times. 32 PE ratio means it takes 30 years to get your money back buying this company. Either earnings have to double to get the valuations right, or the price has to come down. Now, it might not come down, but it might not go up for a long time to get those earnings.
As the
back
earnings graduate.
That's right.
That's right.
So either way, all stocks right now for the next 10 years, probably a bad idea. Probably a bad idea. Also, there's another one's probably a bad idea. Since interest rates are starting to go up, I see more customers and people holding cash. I'm going to wait till it gets to 4 or 5%. And I'm going to tell you, anytime it gets that far, it's not there long, because the Fed will beat down interest rates 20 times to get it back to a low number.
And if I can clarify, when Victor says a bad idea, he doesn't mean don't be in stock markets or get completely out of the stock market. You've got to have your allocation right. Again, the income, the inflation hedge, the stock market, your cash. But if you're not in the market at all right now, what he's saying is now is not the time to get into the pool.
Yeah, what happens is people, though, they're waiting for this, 4 or 5% CD or bond. You can get one now, like a fixed MYGA for, almost 4. I got a A+ rated 3.5%, 3.3 for 5 years. Take that one, and the other guy waits. If it goes up 1% a year, which it won't, it will never go up 1%. But if it did, by the time you're 5 years up, you'll be at your 5%.
Well, compare
this
that. This
will make 3 times more interest if you just take it now.
Compare that almost 4% on a 5-year, right, to a 10-year bond right now, and it just hit it was 3.1 or something. Yep. Yeah.
So I would rather have that any day. No interest rate risk, things like that. So don't wait for it. If you can get 3 or 4% right now for a 5-year deal, buy it. And if in 5 years it's still a little lower, you're still better off. It's impossible to buy 1-year ones and then wait till it gets to a certain point and buy it. That's not impossible. That's what people are doing.
Yeah.
But you will lose out on half or more of the interest just if you just locked it in now. I know as we get older, people always bring things closer. They're like, when they're young, they say, I'll buy a 10-year investment.
And simplify.
And they get like 50. Well, I don't buy anything anymore in 5 years. And they get 60. They're like, it's got to be 100% liquid.
It's like buying green bananas.
That's right. That liquidity costs you too much.
Yeah.
Think about, I'll give you an example. They go, I would never do a 5-year anything because that's ridiculous. It's got to be 100% liquid. Liquidity is important. They're right. Liquidity is important. But let me say this. Okay, let's say you put half your money. I'm not suggesting putting half your money in a 5-year thing paying 4%.
Right.
Okay? Can't touch it for 5 years or only the interest. that means in order to really need those funds, you had to go crazy as hell and spent the half of your money in 5 years. So you're retiring after working for 40, 50 years, right?
Right.
Your first 5 years, you're spending half your money. That's ridiculous. You would never do that. Nobody in their right mind would do that. So that tells you right there, you can put half your money for 10 years or more probably, and easily never need it. Because if you ever need it, you have gone nuts. There's something wrong with you because you saved for 40 years, you just spent half your money in 5. But I see it all the time.
And again, if you have your liquidity taken care of, we've talked about it, whether it's 6 months or 12 months worth of expenses, you have that locked in and you have your income. You get your Social Security, whatever dividends you've got going or real estate or whatever, but you have your income needs taken care of. So in retirement, you know that you've got enough to take care of your bills with some growth. Then the other part becomes a lot easier. You don't stress about it. You don't have to worry about it. You're not getting in. You're not getting out. You just go with blue chips. You do the right thing. It just makes your life easier.
Remember, your reserve money always is in cash.
Yep.
Not in the market
or
super
short-term.
Super short-term stuff. I don't care. It's not paying anything. That's not the purpose.
That's the cost of it,
That's
right?
Your growth stuff, for the most part, stocks are a good place for growth stuff.
Absolutely.
You can also have real estate, things like that.
Not penny stocks.
That's right. Your income-producing stuff is now. I'm going to take one variation of this. Income-producing stuff needs to be CD, bond, fixed annuity, stuff like that. Something that has no interest rate risk. The principal can't fluctuate on the downside.
That's right.
There's only one exception that I'll put into that.
Variable?
Nope. The only exception would be rental property. Because even though the principal can fluctuate, you're kind of set on the mortgage payment or the taxes. You know, they go up a little bit every year. But you've got a built-in thing. You can use that. Now, does that mean take 100% of your income from rental properties? That's not a great idea either. If you've been in Dallas or anywhere, you see real estate go up and down. And you're going to have issues with that stuff if you have all of it in real estate.
If you don't have it occupied, if you've got more expenses than income, I mean, you can actually lose short-term on those
That's
too.
Right. I'm thinking if you rent a property is not a horrible thing. It's decent, right? You just can't have all your money in rental properties. You can, but you've concentrated everything into one asset class, which is dangerous.
Got it.
So let's say you're getting $1,000 a month from this property. Really good tenants, all that kind of stuff. Whether it's $1,000 or $100,000 a month, doesn't matter. Maybe say 80% and use that as the number. I only need 800 of this, so I could count 800 out of 1,000, since it's not guaranteed for life and you could have vacancies here and there.
Right.
And right now, you don't have vacancies. People forget, it was 2008 we had the last real estate crisis, right? Back in the 80s we had one before that. But they forget what happens. Everybody goes, no, the rental properties would always go. No, they won't. Everything starts collapsing in that stuff.
Yeah.
Because what happens is people they lose their job. They can't afford rent anymore. And so that kind of stuff always occurs. And so income producing stuff, when you're in retirement and when you're preparing for retirement, within 5-10 years of retirement, start thinking about fixed.
Guaranteed income producing
That's right.
stuff.
The only reason annuities are so popular in relation to bonds or CDs now is the rate. That's it.
They pay the most right now.
I got $1 million in CDs. I'm going to get 10, 20 grand a year. Bonds, I'm going to get 30, 40,000 a year. I can get an annuity 60 to 100,000. Depends on how long you defer it. 60 to 100,000 a year. That's why people are picking annuities. But it doesn't matter. All of those work perfectly because the principal can't fluctuate and you're getting a set guaranteed amount of money. That's how you set up a portfolio for retirement. Stock market, then you've got to go and allocate correctly, diversify properly, all those kind of things. But once your income is taken care of, do that first because the bills never stop. Well, that's our show, folks. I want to thank everybody for listening today. Remember, don't hesitate to call us if you have any financial questions. You'd like to take advantage of our no-cost, no-obligation written retirement plan. And we include a Social Security optimizer on that. And we'll answer any questions you have about your portfolio or about investments in general. Our number, 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure for Guy Allard. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.